Hello, and let's talk about lending. So, the reason why I am filming this video is because there seems to be some confusion around how banks lend us money and what it's actually based on. So, a lot of people think, or some people come to me thinking, oh, because I have equity in my home, I should be able to lend money. Or some people come to me thinking, fuck, I'm riddled with the complete opposite end, right? So they might think, oh, I have all this equity, I could just borrow it, right? Not true. And then the flip side to it is a lot of other people also come to me thinking, well, I have so much debt. How on earth am I able to borrow this money? Okay, so let me try and simplify this as much as possible. When it comes to lending, it's about income versus debt. That's what it's really about. Income that you have coming in versus the debt and the repayments that come out each month that you are responsible for paying for. Okay, and then it gets deeper from there. This is the reason why you need to have a broker. The broker is the most important person to have on your team. I've personally gone through 12 brokers in my last 8 years of investing, and I now have the most elite brokers on my team that niche in certain things for certain criteria or certain people. So for example, I have brokers on my team who are really advanced in lending for those who are on visas. I have particular brokers who are really good just for SMSF loans, so taking out your super and borrowing money inside super. I have specific investors specifically just for clients who are directors of their own company and business owners, because you should have a broker on your team who is a director of your company if you are a company owner, X, Y, and Z. So, and then I have other ones who are real niched and helping those who are over the age of 50, for example, versus, because then you need a lot more strategy around that. So the reason why I'm filming this video is because this I thought was more common sense. And obviously in my world, I tend to sometimes forget about that. So we're going to talk a little bit more about income versus debt. I'm going to give you a bit of an idea in terms of how lending typically works in the middle of 2025. It's really got to do with, obviously, the interest rate environment as well. So at the moment, in the middle of 2025, as an example, interest rates are roughly, or your borrowing capacity as a really rough gauge, is roughly 5, maybe if we squeeze it, 6 times your income. That's if the interest rates are with like a 6 or a 7 at the moment. But then it will become less once you then start to take away debt that you have. This is a broker's job to do this. So if you are at the moment earning, say, $100,000 per year and you have zero debt, and that's $100,000 in terms of profit. So if you're a business owner, this needs to be either profit inside your company or a wage to yourself or dividends, okay? It's about 5 or 6 times your income. 6 is really stretching it, but 5 is a pretty good rule of thumb. In 2022, when interest rates were starting with 2s and 3s, the borrowing capacity back then was on average 8, even up to 9 times your income, which was pretty cool. So that's a very basic rule of thumb. If you're somebody who's watching this with no debt, then you can genuinely say about roughly 5 to 6 times your income is a pretty good gauge. Okay. Then it gets complex. Your interest rates can be lower based on your LVR. Say, for example, you own a home and your LVR, which is your loan to value ratio, say, for example, that is the property is worth $700,000 for your home and your debt on it is $300,000. Then your LVR is very low. And so that means we're not getting closer and closer to that ceiling. So the closer and closer we get to the ceiling of pulling out too much equity, then the interest rate starts to become a little bit less. I'm not going to go into LVRs too much today, but interest rates drop dramatically the lower your LVRs become, but it kind of caps at 70%. So for example, you might be offered an interest rate 8% if you're taking your LVR right up to from 80% to 90%, which means you're taking out a lot of money out of the deal. Now, this is quite advanced stuff, right? This is not stuff that you necessarily need to know as a beginner investor, but it's absolutely stuff that you need to start to learn, and stuff that I teach my clients once we get further and further into it, because you really need to understand that the game of lending is really 60 to 70% of the property investing is understanding how the banks judge us. It's so critical to understand how a bank judges you. So one of the things I always get my clients to do is every time they get their borrowing capacity number, I say, right, this is your benchmark. We now need to utilize this benchmark moving forward by forecasting different scenarios with your broker before you're about to change something. So say, for example, you're about to make a move, whether it be buy a house, sell a house, get a credit card, pay down a credit card, swap jobs, get a pay increase in your job or a pay decrease or something like that. Every time you're about to adjust something in your personal circumstance, which is going to impact the income versus your debt, then you always need to go back to your broker and say, hey broker, I'm about to make this move. What will my borrowing capacity be when I make that move? Then what that starts to do is starts to paint a picture around how the banks judge you. And you start to create a pattern in your own head about how they judge us. And the environments always change. And by the way, none of this is financial advice. And also, this could be completely thrown out the door in 12 months from now, this video, because the lending environment literally changes monthly. And there's over 440 lenders in Australia. And that's why it is absolutely stupid to go out and get lending on your own if you're going to be an investor. If you're just going to be an average mum and dad and just buy one home and your whole dream is to pay down the home mortgage, then yes, the interest rate matters. Interest rate doesn't really matter. It's not the core focus when you're an investor to begin with. All right. The most important thing is who's going to give me the most amount of money with the most amount of flexibility inside the terms and conditions for the next loan. Okay, so income versus debt is the most important thing to understand. Then this is the reason why you should always go back to your broker and say, well, if I was to sell off this, then what would my borrowing capacity be if I did that, right? Next things, yes, job titles can impact your interest rate because there are lenders out there who like people who work for the little scummy government. So, for example, there are roles out there that the banks favor. So say, for example, if you're a doctor, a lawyer, a teacher, a nurse, a police officer, you might be in the RAF of some sort. The banks tend to say, well, you look more sophisticated on paper. We trust you. They have this idea about you that you're genuinely in that type of role for a really long time, such as it's a high qualification type of role or it's a real safe sort of role. And based on the tenure of how long people are in those roles, the banks like you more. And so it's easier for them to offer you more money, but more around the job title that you do. And so they'll offer things like, for example, free LMI. Now, that's not with every lender, but LMI, which is lender's mortgage insurance, they can literally give that to you for free. I've got a whole entire segment on it. If you want that, reach out to me. I'll give that to you. And they can give free LMI. And in some very rare scenarios, even give free LMI for, say, I've got a client at the moment who is the wife is a doctor, so she's a surgeon, and the husband is a lawyer. So very sought after sort of professional people that the government love and that the banks love. So they are able to get free LMI inside a trust, which is ultra rare because a trust don't even normally have free LMI for those people. What happens is if you get free LMI, well, that's a bill that you don't have to pay for, which means what? We can then take and borrow more money. And it also, because you're not paying for that bill, which could be, $7,000-$10,000 bill add on to your 30-year mortgage, it's then again making your borrowing capacity look higher. Okay. Business owners. I've got specific lending around lending training specifically for business owners. If you are a business owner, I'm really surface level going into this. This is not, I have specific training. Reach out to me if you want that. We'll go into deeper on that. But for example, for business owners, your borrowing capacity starts to drop a little bit more because most business owners who have private school fees for their children shaves off a little bit more as well. So again, another reason why I need a broker. Trusts, again, I have specific training that goes deeper into training for trust, but trusts usually have a lower borrowing capacity as well. And by the way, I'm about to show you a whole bunch of examples as well that I've got from my brokers that my broker will tend to send to my clients as like hey, this is your borrowing capacity and this is why, and this is some examples of what we can do. So we're about to get go through some examples. So trust can usually be borrowing inside a trust is usually a little bit less because most times, and again, not all lenders, but most lenders for trust will usually add on roughly 1% higher. So that means your borrowing capacity is a little bit smaller to begin with. But trusts have this way of basically infinitely protecting your borrowing capacity by ignoring debt. So it's like taking one step back to go, 5 steps forward for the future you, if you're going to be an active property investor. Now, some banks will also add on 3% buffer to when they're assessing you. So say, for example, a bank's all right, we're going to give you 9% of your interest rate, but they're actually going to add on 3%. So they're going to assess your borrowing capacity based on your interest rate actually being 9% interest rate, which would do what? Imagine if you had multiple loans. Your borrowing capacity would be fucking hit massively. So again, another reason why you need a broker, and another reason why the lender that you choose should not matter. I'm emotionally disconnected from my lender in every way, shape, or form. I don't give a fuck who gives me money. You're going to give me money. I know that I can compound your money into another asset and get an average of 67% capital growth, which is my team's average. So I don't give a fuck what the interest rate is. That's the last thing. And you can always refinance and move lenders later on as well. Some people, though, are actually forced to stay with a lender. So some people, for example, when we, during 23 and 24, when we have some people who were with a lender where they had a fixed interest rate, so their loan or their mortgage on their home that they had to pull their equity from, it was fixed, and it was fixed at an amazing rate when everyone else is paying 7%, but they're fucking locked in at 2 or 3%. Sometimes it made sense for them to stay with the shitty lender that they're with, and then to pull out the equity in the short term, and then we use other lenders later on who are not going to add on that 3% buffer. Okay, and by the way, not all lenders do this. There's a lot of amazing lenders that don't add on this 3%. Everyone thinks that lenders add, most people think that all the lenders are adding on 3% buffer. They're not. It's just some. Another reason why you need to have a broker. Okay. Rental income. So a lot of people think also that 100% of the rental income you get from your tenant is included. No, it's not. So again, depending on the lender, some lenders will shave off 20% off your income. Other lenders will shave off fucking 50%. Other lenders will accept 100% of the rent. Even though you can prove that, hey, my tenant's giving me $400 a week, in terms of rental income, the bank might actually only consider as if it's $350 a week. So again, that can impact your borrowing capacity. That's another reason why if you ever want to improve your borrowing capacity, actually the easiest way in the short term, just go and get a permanent part-time job for a month or two to get the next loan across the line. Okay. And we don't know how much longer we'll be able to do that. It's been around for years and years, but who knows? The banks could stop that at any moment. There are absolutely lenders out there who can get around credit ratings being bad. I have multiple clients who have, paid their bills late on time. And by the way, you can't get away from this shit anymore. Like, the banks can fucking see everything and they will request everything. And if they don't have visibility of something, they will say, go and get us this proof. So there's heaps of lenders out there that can see the good and the bad. Well, they do that with there was a new thing that came out in 2018 or 19. I can't remember what it was called, but back in the day when it came to seeing your credit rating, it used to just be they run a credit report and they used to just see just the bad side of you, but they wouldn't see the good side of you. And then they introduced the good side. So now they can see the good side and the bad side. So they can see that you're, paying off all of these mortgages and all this amazing stuff, but you might have been bad once or twice on this one credit card over here. So now they can see the good, which is a good thing, I think. So yes, there's heaps of lenders out there. We can literally get around, them not looking at your credit rating. What that means is in the short term, is it might mean you got a high interest rate, or it might mean you have to put in a larger deposit or something like that. So again, that's something I work really closely with the brokers. And yes, there are lenders where we can absolutely ignore debts inside companies or trusts as well. That's again, this is for quite active property investors who are using trusts, or business owners who are set up as a company. So if you're a business owner watching this, I would like to put all of my debt as much as possible under my company name. Again, non-financial advice, but that's if you're obviously not planning in the short term to sell your company, because obviously you need to balance that out. And then car leases is another one. You want to be careful with car leases versus a car loan. So I have a full pros and cons list as to buying inside, especially if you're a company owner watching this. But just as a generic, just to let you know, if you go out and get a loan, say you want a $40,000 car leases are amazing at getting lower, at reducing your taxes, right? Especially for an employee. That's probably the only main biggest thing that people have to reduce their taxes is getting the car on a car lease. And fuck, I've had car leases before and they're so convenient. I massively thrive them. But the downside is that the banks like them a lot less than a normal car loan. And that's purely got to do with the fact that a car lease, it's taking the money out of your income before you pay taxes on it, which means the bank, when you're an employee on paper, the bank looks at your gross income. So if you're on, say, $100,000 wage per year, and then you've got the car lease coming out, let's just say that's going to cost, I'm making up a number, say $80,000 a year, $20,000 for the car lease. So on paper, the bank's going to look at you as if your wage was 80 grand, not 100. And so it's always better from an employee perspective to look at your gross wage, which is different for business owners. I know, a little bit confusing if you're a business owner. Again, we need to watch my training on lending for business loans. So as an employee, you need to be careful to think about into the future. If you're going to lend money, run this past your broker and say, hey, broker, I need to get a car. right? Let's just say you're planning on it. You want to get and this is something I work with again very deeply with my brokers and my clients as well, is the ratio of, okay, if I need a car, how can I make the car happen, upgrade that and at the same time, how do I get an investment property at the same time? So you need to be careful to assess it, whether or not we should be using equity, and that's if you've got enough capital versus if you have enough borrowing capacity. Does it even matter? You might have a borrowing capacity of $2 million or $1.5 million. We don't need to really worry about your borrowing capacity. Fine, go get the car lease. It's not going to fuck you that much, right? In the short term. And it's just cycles. Like I remember during times of my investing career, I'd be like, okay, my borrowing capacity is great right now. I can afford to go and get the car lease. Probably only going to have the car lease for the next 2 years. And then at the end of that 2-year period, I'll get rid of the fucking car lease right at the same time, and I'll time it with when I need to get the next investment property. So yeah, something to food for thought. Okay, so I wanted to give you some examples. This is the fun shit. This is literally, I've screenshot it. I know this looks rough as fuck. I'm not that good at editing or making things look pretty. Okay, I'm just really good at fucking investing, getting the bank to lend me money. Anyway, okay, so I've got some examples here. This is actual screenshots of actual clients from my broker to my clients that I get CC'd in on all of these because I play a big role in this. All right, let's go through this one here. So this is scenario number 1. So this client had brokers turned around and said, okay, you can borrow $800,000. That's the most important number that I care about. But if they were to borrow inside a trust to start off with, it'd be $690. Why? Because of the 1% I was kind of telling you about, right? Where it's like the interest rate's a bit higher. So for this example, this client has $500,000 cash, right? So what we're basically suggesting to the client is purchase the first property inside a trust up to 680, really capitalizing as much of the borrowing capacity as we can. She's obviously going to put in a large amount of cash for that. And by the way, we're not sourcing properties that high, source properties, and she won't even need to use that much cash. She'll actually be able to spread that $500,000 across 4 properties quite easily. And then design a new trust, aka a new entity, so we can ignore the fact that the 680 even exists and borrow another 680 again, and rinse, repeat. Again, because doing it inside trust means that we can ignore the debt that they took out in the first place. Because she's using a cash deposit to begin with, it makes it easier just to keep that borrowing capacity. It'll mean that her borrowing capacity will stay the same, assuming interest rates do not go up or down. Okay. If interest rates come down, which we're entering that cycle in 2025, this borrowing capacity as a whole will actually technically increase. So that way, technically her borrowing capacity will always be 800,000 if interest rates don't change and her personal circumstance does not change either. Okay. This one, right? Again, you'll see the borrowing capacity changes, right? 870 personally, and then drops down to 540. And then what we're suggesting is, right, is we're getting obviously, this is about evaluations and LVRs, which I'm not going into. That's not for the purpose of this video. And then what we do is, what I would really, really like about good brokers is they'll give a bit of a couple of tips and tricks to begin with. So straight up, we're suggesting get rid of your debt. So if you've got some available equity, which this particular client does not have available equity, they're already really, really tight. So I've recommended to this client, you don't need to pay down your HEX debt at all because they don't need the borrowing capacity to be any higher. It's fine. But also in conjunction, they don't have enough equity to pay it down. So we can pull out your equity to obviously pay off HEX debts as well. And then obviously explaining that, hey, this will, if you close something, that must be a credit card, which I've wiped off. Obviously, that will then increase your borrowing capacity by $300,000 as well, is what we're suggesting. So again, they're just saying, hey, this is an idea to increase your borrowing capacity if you wanted to. It can go up if you were to do this. And that's probably closing off a $10,000 or $20,000 credit card, I'd say. Awesome. And then we're just obviously explaining that, again, if you buy inside a trust, here we can infinitely keep protecting this borrowing capacity here. Okay. And then we've obviously got borrowing side SMSF, which is very different. Again, I have another video, a whole bunch of videos on SMS lending and pros and cons on that if you want to watch that. Let's go to the next examples. Okay, now we're getting even more interesting. So this client, 1.4 is their original borrowing capacity inside the personal name, but again, it drops a little bit at 950 if inside a trust. what else? And then obviously we're suggesting, hey, because your debt on your home mortgage is quite low, again, if you are considering doing rent vesting, that is another way that will increase your borrowing capacity even more. Now, this client is extremely open to doing rent vesting, which means they're not going to live in a home that their own. And so what we're going to do is that person is now told them, okay, go and grab us 2 numbers. Those numbers are, 1, if you move out of this home, how much could you rent it for? And 2, if you go and rent somewhere, how much would your rent be somewhere else? And then we'll get the actual borrowing capacity and see how this 1.4 number would increase by, okay? And now, again, another sort of recommendation as well is to consolidate, so pull out some more equity that they've got, because they've got heaps of equity, to then pay down some of their personal loans, which would increase their borrowing capacity, but also help improve their cash flow, because we're using debt on mortgages and the loan term is longer and the interest rates are lower. It means that they will have more cash flow in their back pocket each month, which will allow them to buy more investment properties, which will inevitably allow them to grow wealth much, much, much more quicker. So you can see the aim of the game is actually not to pay down debt. That's another whole entire topic. Okay, cool. And let's look at this last one. I really like this scenario. So this guy came to us. This one's interesting. This guy is with Rams at the moment. Now Rams has shut down. So if he's in his current situation, watch this, right? His current situation, he can only borrow $200,000. But here's the thing. Let's move on. We're recommending, because he's riddled with car loans, personal loans, he's got a loan for solar. If we take out heaps of equity that he has, which is paying off about $80,000, put it onto a home mortgage, his borrowing capacity would then go to $990,000. So he's going from $200,000 borrowing capacity to $990,000 by simply using equity that he has in his home to pay off $80,000 worth of what we call dumb debt, meaning debt that's attached to his personal loans, car loans. Dumb debt is the stuff that doesn't produce income from the bank's perspective. Now, that would still leave this client with $143,000 worth of equity as the cash to pay out and pay for the next property, which is fucking awesome. So this here is one of those really big quick win clients that we fucking love, where like we can actually, their lives are going to be changed. And what'll happen is, well, our average of our properties are growing between $100,000 to $200,000 in capital growth by year 1. Bang, guess what? That investment property alone will obviously be able to get rid of that $800,000 mortgage if we wanted to. Not that that should be the goal, I personally think. So there we go. That is an amazing win and something that I wanted to share with you, where clients come to us, we're able to get rid of a heap amount of debt, we're able to massively improve their borrowing capacity, which is one of the 4 big pillars that impact your overall wealth and the ability to keep buying more investment properties into the future as well. Now, there's a lot more to lending that I've not gone through in this video, because it's quite deep, and this is also the things that I go into individually with each of my clients. The reason why I was able to get to 5 properties in 5 years whilst only being a call center worker on a below average income, I did that because I understood this shit. I understood why banks really judge us, and this is the stuff that I dive deep into with my broker and with my client, and I basically am like the translator and the middleman to say, okay, now this is how we increase it if we need to. This is what you need to be wary of. And I use those numbers as the thing to forecast for my clients to say, right now, this is how many properties we can buy. This is how quick we can go. All of that sort of stuff. So hopefully this video was of value to you. If you have any questions, please leave a comment below and I can send you, I have just about a free video training on just about everything and anything that you need when it comes to property investing. And if I haven't, I'll create one. So I love to hear feedback. So please comment below what you took away from this, if you learned anything, if it was helpful, and share this with someone that you love.